Devina, ma'am, the first question comes to you. You've been a market veteran and have seen these cycles many times, and there are some people who are seeing it for the first time. Uh, Given the global turmoil, how do you see India positioned with respect to investments from the global world as well as for Indians in the next 12-15 months? And I don't want to talk long term because at this moment, everyone wants to know what to do next.
Uh, Good afternoon. Actually, I never give an index target either in January or when the new Samvat starts. I haven't done it for 30 years. And it's something Daniel Kahneman, one of my favorite authors, calls objective ignorance. That these are things not only that you don't know, but you cannot know. So life and markets are only about probability. So anybody who's investing in equity, whether directly or through a mutual fund or PMS or AIF, should know this, that nobody has this crystal ball that they can tell you what will happen in 6 months, 1 year, 2 years. Bloomberg, which collated data on this on the US markets, because everybody gives this S&P 500 target at the beginning of the year. And this I'm talking all the Wall Street firms you've heard of, the Merrill Lynch's and the Goldman Sachs and the Citicorps and HSBC. It has absolutely nothing to do with what the actual result is. So anybody who gives you a target, please ask them what they said for the last 10 years and how it matched up, because that nobody has. Now, in terms of probability, I think the probability that 2026 will be a better year than 2025 for Indian equity markets is quite high. And one of the major reasons is because the sentiment is so negative. So, this is when people are asking, should I remain in the market? Should I get out? Should I stop my SIP? Or if you look at people talking on either digital media or television, for the first time, fund managers, I hear talking of the risks. Otherwise, everybody was selling, quote unquote, the India growth story. So sentiment is a contraindicator. It is not my opinion. Comes out of research studies that whenever sentiment is negative, the next period returns are likely to be above normal. When sentiment is extra buoyant, like in 2024, up to August or so, everybody thought like 30-40% compounding to kahin nahi gaya. It's like child's play to get that. And then the next Samvat, you got zero return. So, and actually the indexes don't even capture the full pain in the market. 2025, the indexes were up, but the average stock was down. The median stock was down. 57% of the stocks were down. 40% were down more than 10%. So a lot of the listeners would see a lot more red in the portfolio than is captured by the indexes. But as I said, all this negative sentiment is actually good news. But so it's time to be invested. So whatever is your equity allocation, it should not be 100% of your portfolio ever, because equity is money you should not need in any circumstances to take out within 7, 8, 10 years. So that should be money you don't need to touch. And it is definitely time to be invested, not time to sit it out. And this is a statistic I've given very often. Now I see some others also giving it, which is that from the beginning of Sensex to now, which is 40 odd years, if you had missed out on the 10 best days, you would give up 2/3 of your returns. If you miss out on the 30 best days, which is average of less than 1 day a year, you give up 90% of the returns. So most of the time, unless you see a real danger of a big crash, which I don't see either in terms of valuations or in terms of trend line, uh, you should remain invested. So that's my take, that you should remain invested. And last year, we started with the global thing. So last year, India was one of the worst performing markets in the world. It was number 36 in a list of 42 major markets. In the first 1.5 months or so, it was rock bottom. It was last index, and also at a time when the top 5 indices were all emerging markets. So even then you did not perform. But as I said, all these ultimately the thing changes. And again, I mean, if you're looking at indications, the SIP flows have declined, I think, after a very long time. So if you look at, again, long term, you plot mutual fund inflows, they tend to peak near the peak of the market and they come down near the bottom of the market.
Thank you so much, Devina ma'am. And so rightly said, if anyone in this world knew what is the bottom and what is the top, they wouldn't need anyone else to advise them. What we can only do is take informed decisions and remain true to the asset allocation and long term investing. Like ma'am very rightly said, your equity allocation should not be there for 1 year or 2 year. You have to take a long term view if you have to create wealth. Making money even traders can do, but if you have to create wealth, it has to have a long term view investments through equities. Devina ma'am, while we said we can't time the market and it's very difficult to say are we at the bottom or are we at the right time for investment, if you can throw some light for the audience on the major risks that we are seeing today in the market, looking at the global and the political scenario internally, what are the risks one should be aware of while making their investment decisions?
Actually, risk is something you don't see coming. I mean, that's the basic fact. So if you go back to 2020 beginning, obviously you didn't know a pandemic was coming. But if I had told you something will happen which will disrupt the world to an extent that whole industry's revenues will go to zero, aviation, hotels, auto, retail, would you have said that there would be a bull market? So, in hindsight, we all find these reasons, liquidity pump kiya, ye hua, wo hua. If you go to 2022 beginning, the Economist, which is supposed to be this 100-year-old uh, magazine with all this perspective in politics and economics, talked about the 12 geopolitical hotspots. And they did not mention Russia, Ukraine, where the war broke out just the very next month. So this is the truth of risk. We've spoken, I mean, briefly in between about asset allocation. So that's something I would like to, tell the viewers that asset allocation, when we talk of that it is 85-90% of your returns, it is not just Indian assets. That's the part that's missing in most Indians' portfolio, and that's a big risk because then you're putting all your eggs in one basket in a market which is not even 5% of the world. So if you want to talk about risk, that's the risk. If when I started my career, the dollar was 12 rupees. Today, when we do financial planning for 10 years, 20 years, 30 years, we cannot forget that the rupee depreciates. So, which also ties into gold. Our grandmothers were not wrong in buying gold, but because at that time you could not invest in overseas stock markets or any kind of markets, the only hard currency asset you could buy was gold. But gold in dollar terms is more volatile than equities. The 1980 high of gold was not crossed for 27 long years. Even almost 2 decades after that high, it was down 60%. And that was not an aberration. Next high, again, you saw a 40% fall. So, I'm a very data person. So you have to look at long-term data, not just that, knee-jerk gold is a safe haven. Or for that matter, what you said about the internet. I just wrote a column on this, that the dot-com boom, I have lived through it. 95% of those companies went bust. Yes, you had an
Must,
Amazon.
yeah.
You had an Amazon, which has been a multi-bagger, which of course, that's one of our most famous calls back in 2001 when everybody on Wall Street was negative on Amazon. But, we can't say that invest in technologies of the future. The next wave, it became that invest in the people laying the pipes for the internet. And those companies also went bankrupt. Global Crossing, which laid the undersea cables, we still carry the internet on that, but Global Crossing itself went bankrupt 20 odd years ago. And so, I mean, every time you hear hype against about this new theme, whatever that theme is, you don't know whether that technology would succeed, how long it will take to succeed, which company will succeed, and ultimately whether investors will make money in 20th century, which are the most transformational technologies which change the way the human beings live, automobiles and aviation. And both have been a graveyard of companies. The investors hardly ever made money in a car company or a airline. So it's never that easy. So do the boring stuff right. So don't be on either end of the risk spectrum. Do asset allocation. asset allocation means that at least 30-40% of your assets should be global. For me, it is 80%, but at least objectively speaking, it should be higher, but at least go to 30-40% over a period of time. Have gold and silver, but I mean, my recommendation is that have that in single digits. I mean, that's what we do in our asset allocation for India and global multi-asset products. And no risks, as I said, will come from any side. You don't know, so you can only plan your strategy, and never have 100% in equity when you are young, and don't have 100% outside equity when you retire, because there is still a 30-year at least you have to plan for post retirement. So those would be the broad parameters. And always in any kind of stock investment, have a stop loss. But the best thing you can do for your portfolio is, when you invest, tell yourself that I may be making a mistake, because the best fund managers, the best investors in the world do not have, let alone 100% hit rate, even a 80% hit rate. So a significant portion of where they get in, they have to get out. And the smart investors understand this. Warren Buffett sells 80% of what he buys within 2 years, 50% within 6 months. So that's his hit rate. So, I mean, obviously, be ready to admit your mistakes simply because you don't know the future. I mean, so certain stocks will not do what you expect them to do. Life is a game of luck and skill. So don't forget the probability part.
That's so insightful, ma'am. And I would like to touch upon a emotional question to all of y'all, and anyone can take the point to answer first. What difference do women bring to decision making in investments? And we all know that women are multitaskers and they can take decisions faster. They are more organized. With all these qualities, how differently women take decisions? And I'll open the floor to all three of y'all to answer.
Well, the data shows that women investors actually do better, but the men are more confident. So, I mean, it's a cause for me that far too few women manage their own money. And I'm talking even professionals, they might be senior civil servants, or, in academics or science or whatever, and they are still not managing their own money. So, one of my causes is to get people to get women to manage their own money. And also because money conversations often don't happen with girls, or rather daughters, as they do with sons at the first time. A woman often faces the money question is that when they are in their 20s and already earning. So, and then they defer to their fathers or later husbands or whoever. So, since we talked about asset allocation, the main thing is to get the asset allocation right, which is not so complex. So even if you do not have a training in finance, please take charge of your own money. And as I said, the data shows the women do a better job, partly because they are not doing it as much for entertainment, because many of the men, I mean, it's my strong belief that many in the equity markets do it for entertainment, that otherwise what am I going to talk about in parties or on WhatsApp and Telegram groups? So,
So the learnings from this, Devina ma'am very clearly said that we can't time the market and we can only see the risk, but we don't know when is it coming. Best to have the asset allocation right. AI is there to come and change the world. How it will change the world is something to be seen. If you're rightly positioned in the market, it will help. And in the last, remain allocated. This is the time to invest in equities, not all the money now. Just stagger it and invest. Investment is the key. If you're out of the market, you can only miss it. Thank you so much, fellow panelists, for joining.